Oil is back in the spotlight, and surprisingly, one of the countries people haven't talked about in years is suddenly relevant again. Not because it's booming, not because investors are rushing in, but because global energy markets are tight and every marginal barrel matters. When oil supply is constrained, markets start paying attention to places they've ignored for years. For ETF investors, the question isn't how to invest in Venezuela, because you can't. The real question is which ETFs benefit from the situation Venezuela creates. This is the ETF Investor. Let's get into it. Over the weekend, a dramatic geopolitical event unfolded as U.S. forces conducted a military operation in Venezuela that resulted in the capture of President Nicolás Maduro and drew immediate reactions from markets around the world. This development followed weeks of mounting pressure, sanctions, and naval blockades targeting Venezuelan oil exports. Vice President Delcy Rodriguez has assumed interim leadership, but the political transition is far from settled, and U.S. officials have signaled a possible role for American companies in Venezuela's oil infrastructure going forward. Almost immediately, markets reacted. U.S. energy stocks rallied, and many investors interpreted the news as a potential precursor to changes in Venezuelan oil production and export policy, even though meaningful production increases would take years to materialize. Integrated energy companies saw significant gains, suggesting Wall Street is pricing in the possibility of future oil sector investment in Venezuela. Crude oil prices themselves jumped shortly after the news, with both Brent and WTI rising as traders assessed the geopolitical upheaval and the ongoing constraints on Venezuelan exports. At the same time, other market reactions included rallies in Venezuelan government and PDVSA bonds as hedge funds, and distressed debt holders positioned for potential recovery value, and classic safe haven assets like gold and silver rising on geopolitical uncertainty. So what does this mean for ETF investors? Here are the top thematic ETF plays given the current situation. The first and most direct set of beneficiaries are energy sector ETFs. When Venezuelan supply is limited, global oil prices tend to stay supported, which benefits integrated energy companies rather than the country itself. ETFs like XLE, Energy Select Sector SPDR Fund, and VDE, Vanguard Energy ETF, provide broad exposure to integrated energy producers that have the scale, balance sheets, and infrastructure to profit when oil prices remain elevated. These companies benefit precisely because Venezuela cannot reliably supply the market. Tight supply increases margins, cash flows, and shareholder returns for producers operating in stable jurisdictions. The second ETF angle is global energy exposure. ETFs like IXC, iShares, Global Energy ETF, and XOP, SPDR S&P Oil and Gas Exploration and Production ETF, hold names with exposure to global upstream and downstream energy businesses, which can benefit when geopolitical events tighten supply expectations or raise risk premiums in energy markets. This is where many investors get it wrong. They look for country exposure instead of supply chain exposure. Energy ETFs work because they capture the businesses that can respond to tight markets, not the countries causing the tightness. The third ETF play is price-linked oil and commodity ETFs. Vehicles such as USO, United States Oil Fund, or BNO, United States Brent Oil Fund, track crude oil prices themselves. Given short-term volatility from supply shocks and political risk, these ETFs can be tools for tactical exposure. However, these are volatile instruments and should be used for shorter tactical positioning rather than long-term core holdings. That said, oil ETFs come with their own risks, including roll costs and volatility, so they are tools, not long-term buy-and-hold solutions. The fourth ETF angle is inflation and macro pressures. A shock or perceived disruption in global oil supply often feeds into inflation expectations because energy costs ripple through transportation, manufacturing, and consumer prices. In this environment, inflation-protected security ETFs, such as TIP, iShares, TIPS Bond ETF, or VTIP, Vanguard Short-Term Inflation-Protected Securities ETF, can act as a defensive allocation against rising price expectations. Venezuela's situation doesn't just affect oil markets. It feeds into inflation dynamics, interest rate expectations, and broader macro positioning. Energy shocks rarely stay isolated. The fifth category is emerging markets and global ETFs, which get an indirect effect even though they don't have direct Venezuela exposure. Broad emerging market ETFs, like VWO, Vanguard FTSE Emerging Markets ETF, and VXUS, Vanguard Total International Stock ETF, generally exclude Venezuela entirely because index providers do not consider the country investable due to governance, liquidity, and capital controls. This highlights an important lesson for ETF investors. You don't need direct exposure to every country for macro events to affect your portfolio. In fact, Venezuela's exclusion is a feature, not a bug. It protects investors from political and operational risk while still allowing exposure to energy exporting countries that can actually monetize higher oil prices. The big takeaway is this: Venezuela matters again, not because it's investable, but because constrained energy production keeps global spare capacity low. That constrained capacity supports oil prices, and that pressure shows up in energy ETFs, inflation-linked ETFs, and safe haven exposures rather than in Venezuelan assets. ETF investors don't invest in Venezuela. They invest in the instruments that benefit from how markets respond to changes in supply, geopolitics, and macro sentiment. Energy producers, oil price vehicles, inflation protection ETFs, and safe haven assets are all logical themes to explore in the current environment. If this breakdown helped, comment Venezuela ETFs for a deeper, multi-ticker comparison next. And subscribe to the ETF Investor for more ETF reality checks, seeing through the headlines to how markets and portfolios actually move. Know what drives markets, and know what you own.